Good morning and welcome to the Killik podcast for the 3rd of July. This week, the market's been pushed around by headlines in Greece as for the previous week. But the one big piece of data this week has been the non-farm payrolls. So we had a number of 223,000 in May, slightly below consensus. But the average hourly earnings rate was quite a bit lower. So we had a 2% rate down from 2.3% in May. That's pulled Treasury yields back a touch, not significantly, and the equity market didn't react particularly in any way, shape or form. So it was more of the same, really doesn't change expectations on when the Fed will raise rates. Other big piece of news this week is BP has finally negotiated the settlement of their Deepwater Horizon accident. So over 18 months, BP will pay $18.7 billion for penalties from the Clean Water Act. After tax, the present value of that bill is around $11 billion, of which $4.5 billion has already been provided for. So the total bill in aggregate will be $57 billion. Given that they are allowed to pay this sum over a longer period of time, 18 months, we don't think, and the market doesn't think, there'll be any material effect on free cash flow. So the impact on the ability to pay the dividend is negligible. So just looking at the valuation, at the moment the dividend is for 2017 is around 50% covered. So the business needs to improve their operational performance and cut their capex in order to rebuild that dividend cover. If they are successful in doing that, and we think if they can get back to 1 times cover on the dividend, then the shares should trade near a 4.5% yield rather than the near on 6% yield we have at the moment. So that would be about $5.75 on the price. We've also, from the research department, reiterated our buy note on WPP, and I think it's worth going back to why we like WPP. The key big driver for WPP is this continued movement to advertising on the internet and on mobile platforms, and particularly the mobile platform, which you can see here. At the moment, we currently spend around 20% of our time looking at our mobiles in terms of our interaction with these various medias: print, radio, TV, internet, and mobile. But only 4% of advertising spend is on mobile. So there's going to be a big ongoing shift towards that area. And we think that represents around a $30 billion opportunity for the industry, which WPP is the best place to take advantage of that, given their scale in digital advertising already. So in order to enhance that positioning, WPP have made 3 recent acquisitions, so Rentrack, AppNexus, and Comscore. The Rentrack is all about television measurement and film measurement, so their ability to track audiences and their reaction and interaction with adverts. Comscore is a similar sort of measurement company which focuses on the internet. And then we've got AppNexus, which is a real-time ad exchange. That's automatic programmable advertising buying. So really these acquisitions are about being able to track the audience through the internet across different platforms that they're watching or engaging with content, and track the efficacy of the advertising spend. So that's clearly key. They're investing a lot in it, and we think it's a big opportunity, so we continue to like WPP. The week ahead is a light week. We've got Marks & Spencer's and Cineworld from the Killik recommendation list on Tuesday on the 7th. And then on Thursday, we've got Pepsi. Just looking at Marks & Spencer's Q1 numbers on Tuesday, unlikely to be much change from prelims, which came out recently. So markets assuming a 7% pre-tax growth for the year and some help from £150 million share buyback. So the last word has to be the Greek referendum. We've got that on Sunday, so exit polls after the ballots close at 5 p.m. on Sunday night UK time. The polls remain extremely tight. It's probably a small lead for the no vote at the moment, although the yes vote has been catching up. But we know how reliable polls are after the UK election. I think what people are really looking at is the ECB's ability to stem any contagion risk should we get a no vote. And yesterday's announcement that they're going to expand the toolkit on what they can buy with their QE program to government-backed corporate bonds is a statement of intent to increase the protection for the peripheral states should there be a bad result in Greece. A yes vote will clearly be taken positively by the market. We expect the Greek government would then be forced into some sort of compromise and trigger a call for a new election, which would probably take place within 30 days. Then negotiations for the third bailout would restart. So we're by no means in home and dry following that vote, but that'll push any further issues into the long grass for a period. A no vote would obviously create a lot of volatility, and it would trigger a non-repayment of the EU loan, which should also disconnect the emergency liquidity that the ECB are providing Greek banks. So that would clearly cause significant issues in the Greek economy and for the Greek population. So that would not necessarily mean the end of the situation, a point of no return, because you could well see the electorate call for a new government at that stage, which effectively would be a similar sort of response to a yes vote. We feel that throughout this process, probably the upshot will be that we'd see a committed, aggressive ECB that are willing to step in and really protect growth within Europe. And that's going to refocus people's minds on the reflation trade in Europe. And in that sort of scenario, the best sectors to be in are the high beta sectors like autos and financials. But we'll know more on Monday. Thanks for listening. Have a good weekend.